That's it. And we are live, broadcasting only on onedealaway.com/live. This is Money Matters. My name is Nev. And today we are talking the big short. That's right. Today we're going to go back into the real estate market and we're going to be discussing the big short 2.0 or 2020/2021 because we don't know exactly when it's going to come in. And I wanted to bring this familiar movie right here to you because the story potentially is re-emerging yet again now in 2020. And boy, do I have news for you. Now, yesterday we talked a lot about real estate and we talked about all of the problems that are happening within the commercial real estate market. If you haven't watched this, you definitely want to go back to the YouTube channel Money Matters, and then you want to go and click on the real estate, right? The Money Matters show. You want to go into the real estate component and you want to look for a video that was released yesterday, which was October 15th. So you want to go in there, you want to find out what's going on, learn about it, because today we're going to go deeper into the stuff. So the story continues today based off of what we talked about yesterday. So what did we talk about yesterday? Let's recap. We talked a little bit about what's going on with Blackstone and large companies over in Spain and their struggle of trying to sell in that market where the prices are plummeting. That's not the story that we have here in United States right now, but it could be a potential future for what's to come. Now, most folks, and I am one of those most folks, don't expect this whole real estate thing to blow up nationwide and everywhere, and more likely than not in single family, right? We are looking at commercial. So yesterday we talked about commercial real estate space, but what does that actually mean? Well, commercial real estate is split into a few different industries and of course then divided by different locations in United States, because we're going to be focusing in United States here, but it might not be only problem in United States. So if you're located in a different country that you're watching this, you want to take a look for some of the things that we're talking about here and then translate them to what's happening in your country, in your location. Even for US, it's very hard that if you are, for example, in New York City, you cannot compare to what's happening in, say, Oklahoma, for example, because the markets are very, very different. You got to focus to what's happening in your area or the area that you're looking to invest in. So that's the part that we're going to talk about, that it's important to focus on specific niches or tranches, or however you want to call them, within the real estate and the location to understand what's going on. But the biggest problem is that folks are saying there's a potential big short coming for commercial real estate, and we're going to be discussing what that is, what the big boys and girls are doing, right? And we're going to be discussing potential ways that you could play around, because a lot of the things that they do, you and I can't. It's not open to us. It's open to large institutional investors. We're talking hundreds of millions, billions, potentially even trillions of dollars that are involved in all of these things. But what we can do is we can learn from what they're doing and then try to mimic ways to follow, if you want to follow, in what they're doing. So I'm beyond excited that you are here watching this live. If you are here on onedealaway.com/live, make sure you sign in, say hello. We're going to do Q&A at the end of the show as always. And if you're watching this on YouTube or potentially Facebook, because that's where this is going to land as well, make sure you do me a huge favor. Smash the like button right now. Do subscribe, hit the bell button if the bell button exists on your platform so you get notified. And if there's no bell button, hit whatever subscription service, notification service that you can, because we deliver news every single day about what's going on, not just in real estate market, but of course, overall economy, where we're heading. We talk about crypto, we talk about precious metals, we talk about different asset classes that have a potential to preserve and grow your wealth. So if you are in understanding what you need to do, what's happening, but not just to be informed of what's happening, to actually be able to take actionable steps to preserve and potentially grow your wealth, this is a show for you. Let's do this. and good morning. Happy Friday to you. Hopefully, you're not too excited about Friday, but I am glad that you are here. Look, Fridays are amazing. They give us an opportunity to finish the week strong for those of us that work only Monday through Friday, but not everybody has the luxury to do that. Some of us work 7 days a week and potentially feels like 10 days a week, even though there are no 10 days in a week. For some of us, we're excited about the weekend because we get to relax. And the rest of us, we're excited about the weekend because we get to work on the projects and passions that truly fuel us. So, today, my message to you is do what you love doing. Of course, figure out the way how to monetize it. I love investing. I love tweaking on the businesses. I love geeking out on the numbers. And I absolutely love real estate, which is, well, amongst other things, which is the reason why we're doing this show. And I enjoy teaching more than anything else. It just gives me such a joy when I'm able to impart whatever little bit of knowledge that I have collected over the decades and be able to help somebody and improve their life in any way. That is the reason why we do the show, and that is the reason why One Deal Away, which is the company that we own, it's a financial education company that helps individuals who are just trying to figure out ways. You don't want the newsletter. You don't want somebody to just give you fish. You want to learn how to fish, right? How to build that pool, how to get the best bait, how to go out there, where the best locations are to go fishing, and then go and fish for yourself. Because I promise you, if you only depend on a way to get the fish, you will starve the moment that whomever is feeding you goes away. And I promise you, even the best of the mentors and teachers and givers at some point do go away. And then what? So my goal for you is, by watching this show, by joining One Deal Away, by participating, by joining the groups, by communicating, by coming to the live sessions and the chats and that kind of stuff, that you can actually build your number one asset, which is this guy right up here, or gal, I don't know, depends how you refer to your head, but it's really your brain, your knowledge, right? Because that is going to help you a great deal in order to be able to continue, not just to keep where you are, but to continue to grow. Look, we all know and can agree that there are huge problems right now within the economy. Most of us are working way longer, way harder, and getting paid way less. And even if you're not getting paid less, for example, right, your salary might have gone up 1, 2, 3% over the course of last year or 2 years or whatever. I think most people already understand and expect that their salaries are not going to go up in 2020 or 2021. Potentially, maybe in 2022, if we get out of this hot mess, as I like to call it. But most of us also understand that our cost of living has gone up. The inflation, whether, I know it's an argument that exists, doesn't exist. Some of the things are definitely down in prices. Some of the things are definitely up in prices. Well, what is up in prices? Things that we need the most: food, shelter, energy, right? And when I say energy, I'm talking like electric, gas for your car, transportation stuff. Those are the things that are going up in value. Now, technology is amazing. It's allowing a lot of things to be reduced in value. For example, a laptop that you buy today for, say, $1,000 is a way better laptop than a $2,000 computer only 2, 3 years ago. We all understand that. We all agree with it, but you don't. I mean, you do need a computer, right? Today, you can't really live without a computer. You can live, you just can't do a lot of business, a lot of things that you need to be doing, right? So, but you know what I mean? Like, it's not necessary for survival. Food is necessary for survival. Shelter is necessary for survival. So those are the things that are important, and those are the things that are going in price, and they're going in price way faster than the salaries. And the reason for that is because, well, all of this money was printed and it's going somewhere, and it's going into inflating the assets. Stock prices are ridiculously high. I believe that they're overpriced, posing a lot of risk. Real estate is ridiculously high, although there are great deals out there that exist in just about every state, every locale. You just gotta know where to look for those things. And today we're going to be looking at that stuff. So we're going to be looking at the stuff in The Big Short. Now, I don't know if you've seen a movie or potentially even read a book, because I believe that there's a book that exists as well. And if you haven't seen the movie, I highly recommend that you go out there and find it. I don't know, maybe Netflix carries it. I don't have a Netflix account. I am weird. I know. So check it out. I'm sure that you can find it somewhere where you can watch this movie, because if you haven't seen it, it's very, very important for you to understand. It's going to put the entire conversation today, this morning, into a perspective. So if you know anything about it, Christian Bale plays this guy Michael, who is actually a real character. And if you want to hear a true story from him, I believe that the Real Vision, which is a channel on YouTube, has done a video with him, and he talks about his experience. So you definitely want to go out there and find that video and watch it, because it's highly educational and it's incredibly amazing story to be able to hear it. But anyways, he created this fund, right? And in early 2000s, right before the financial crash of 2008, he basically was seeing behind the corner, as they say, of what potentially could be coming, which is the mortgage default. So he decided to go and short the real estate market. But how the hey do you short a real estate market? That is the question that many people have. While the story was really entertaining and it was amazing and it was really good education, it didn't really teach us how do you do that stuff. Well, that is exactly what we're going to talk about here today, of what's happening now with the Big Short 2.0. So first story that we have here is, we've talked about what's going on with the how we can expect that over the next year, potentially 2 years, we can expect that certain commercial real estate is going to go down severely in prices. We've already seen that hotels are getting, when they're getting reassessed in value, they're getting reassessed anywhere between 25 and 50% down from their last reassessment only a few years ago. So the prices of those hotels are going down. Why is so? Well, commercial real estate doesn't get evaluated the same way that residential real estate does. Residential real estate really looks at, your house versus my house and compares them, right? Commercial real estate operates differently. The valuation from commercial real estate comes from the income that that particular piece of property produces. Well, how does real estate get income? It gets it through tenants, through rent payments. Well, what do we know about retail? Well, they're shutting down. Restaurants are shutting down. So the owner of the property where that restaurant is, when the restaurant shuts down, doesn't get any income. Guess what happens to the valuation of that property? It goes down. Why? Because there's no income. When they have a mall, say you have a mall that has 100 stores that could potentially, live there, so to speak, right? And if 50% of those stores close down or don't pay rent, right, and go away, well, guess what? Now your occupancy is 50%. Very similar to residential, slightly different, but very similar components, right? Which means you're getting 50% of the income, which means valuation of your mall goes down. Now, could you potentially be able to learn how to, or be able to pay for the mortgage and the servicing of that and all of those different things? Sure. But at some point, if that mortgage requires you, for example, to be 75 or 80% occupied and you're only at 50, that means that you are starting to go into your reserves. At some point, you run out of those reserves. When you run out of those reserves, you no longer can pay that mortgage. You can no longer service that debt. Now what happens? Well, you potentially have to file for bankruptcy. You potentially default. You potentially try to work with your lender for some sort of forbearance, right, version, or maybe some sort of restructuring. Maybe, instead of, 5 years, maybe we go into the 10 years and kind of try to work out some sort of deal. But the lender is not obligated to do it. Now, a lot of them are incentivized right now to do it, but they don't have to necessarily. So these are the big problems that are happening right now, and I think everybody's understanding it. So I wanted to use this as a sort of entry level story into what is happening now. One of the things that these the big investors that own office space, they're saying, well, it's kind of uncertain. Retail definitely going down, restaurants definitely going down, malls, which is retail, definitely going down. And so where is the saving grace? And they were saying saving grace is within industrial manufacturing, right? We talked about that yesterday. And saving grace is within single family suburban homes. And yesterday we talked about some of the great areas that you could consider investing in. Now, here is a story of what some of the big boys are doing, and they're basically financializing single family houses. They're trying to figure out the way to balance their commercial investment component with the residential stuff and try to figure out the way of like, how do we stay on top? How do we survive this whole hot mess? So let's learn about this stuff, and I promise we will, as the show continue, we will go on. Sales of new houses in August jumped 45% from a year ago after having jumped 50% in July to the highest rate since 2006. We already know that. We already know that, and they're talking about all this stuff that we've been talking about, so we don't need to go into that right now. However, a surge of big money into single family houses as an asset class is something that is happening right now. So the big boys and girls, but it's typically guys. It's just kind of how it is. I'm not trying to be sexist. I promise. I get very excited when women enter some of these spaces and start taking over because I think that they do a much better job, because they tend to be a bit more critical thinkers, and they see things that sometimes we as guys don't pay attention to, don't see, don't recognize for whatever reason. We're just built differently, I guess. Buy to rent companies. So here's what's happening. We have a few different forms of what's going on with the big companies. Buy to rent companies that grew out of financial crisis are companies that are now building new houses specifically as rental houses. Then you have the iBuyers, companies that buy houses and then resell them. And we've been talking about that, what's going on. So if you haven't seen the iBuying video that we've done, I want to say about a week ago, maybe 2 weeks ago, again, you're going to find it on the YouTube channel. So go there and watch it. It's very, very, very important. Companies are buying houses and leasing them back to their home owners. What that basically does is that says, well, and we're gonna discuss this a little bit, but let's explain. So the iBuyers basically is the direct buyer that you can sell to. You can't negotiate with them, but they can close in a few days. You get to choose the closing date and stuff, and they can give you an offer within 48 hours. So you could really provide huge liquidity for the homeowners to get out of it. Now, they're not located everywhere. They're located in specific markets, and they have specific things that they're looking for. So don't be going out there thinking like you can buy whatever you want and just flip it to them. They're probably going to offer you less than what you expect or less than you could get on a regular market. But it is a fast sale, so something to think about. Now, the buy to rent companies, or the companies that are now building houses specifically for rental, are companies that are going out there building, right? They become home builders, but instead of selling those properties, they're renting them, right? So that's an interesting change that we're seeing in the market. And then finally, what they're doing is buying houses and leasing them back to the former owners. So say that you own a house and you're like, oh man, I don't know, I need to get into the money, I can't afford to live in here, I just need a rent, I need to get cash. So the company comes in, they buy the house from you and then just lease it right back to you, so you don't have to move, but now you're able to cash in onto the equity. Do I recommend it? I don't know. Everybody has their own thing of what they need to think about. I'm just sharing with you what exists out there so that you can learn from it. Now, home builder ResiBuild was set up specifically to build houses as rental property. So they are Atlanta-based company now raising $1.2 billion, including $400 million in equity and $800 million in debt to build 5,000 houses with 3 or 4 bedroom and a 2-car garage. They will rent for about $18.50 a month. And of course, they plan to manage those rentals. So that's one of the things that we are seeing right now, that they're raising capital. They go out there, they build all these homes, and instead of selling them for cash, they are renting them. Why would they do that? Well, it's the same reason that why in Flip It Online Masterclass, at One Deal Away, I teach folks of, if you're flipping a property, how you can flip it. in a different regard, because there's a difference when you just sell it outright, because those are capital gains, and it's a very different payment system, very different taxation system when you're able to rent the properties, and now you're getting passive income coming in, because at a capital gains you're paying way higher taxes than you are on an ongoing monthly basis. And the benefit of the monthly basis is that you have continuously income coming in. When you sell an asset, right, you get this lump sum cash that just shows up. But when you run out of things to sell, then what, right? That's the piece that I always keep saying, that the way that we're being taught to invest doesn't make sense to me. It makes more sense to me to look for ways to invest, to get passive cash flow every single month coming in, right? Because that cash flow that comes in, it's kind of like a paycheck every single month coming in, which now can fuel your monthly expenses. And if you set it up correctly, that income should be higher than your expenses, which means that you actually can put some money aside, be able to save up, and continue to invest, right? That's the goal. That's the whole goal of everything I teach at onedealaway.com. So there you go. You've learned what it all is all about. We were already seeing both boomers and millennials move to rental communities because they wanted more room and a low maintenance lifestyle. And of course, many people are afraid to own properties, right? Because you got to maintain them, you got to do a lot of things. So they're looking for low maintenance lifestyle, meaning they don't have to do the stuff. You just pick up a call and be like, hey, you own the place, I need you to fix this stuff. As opposed to, hey, I own the place, now it's up to me to call the plumber, electrician, whomever I need to call to come and fix the stuff if I don't know how to do it. And for some things, if you're not trained to do it, you probably shouldn't be doing it anyways. I'm thinking electric, maybe? That's a little bit too scary if you don't know what the heck you're doing, right? Because it could kill you. It could kill you. All right. So the theory is that people want more space and live in the suburbs but want to rent instead of owning. And I think some people definitely want that. Some people definitely want that ability to, there's definitely something to be said about ownership, because you build in on this equity, and there's a lot of really cool things about it. But there's a lot of freedom when it comes to renting. So if I am just renting a place, I can go and sign a lease somewhere, and be in, Washington, D.C., for example, for a year, and then a year later move to, Arkansas, and then a year later move to Spain, and a year later move to Argentina. So it's a much easier nomadic lifestyle that I can just go and shift. And if I don't like the place, I can just easily move. When you buy the thing, you're sort of kind of stuck with it, right? And people, between the not wanting to do that, wanting to be a bit more mobile. So that's problem number one, or the reason that number one that folks are doing that. The number two is also has to do with the cost of housing. Perhaps you can't afford it. Perhaps it doesn't make sense. And you're like, you know what? I'm just better off renting. And that's perfectly fine. There's benefits and draws for both. Private equity firms, and once again chasing after the buy to rent market, and this includes the asset management division of JP Morgan, nearly tripled the size of joint venture with American Homes for Rent to $650 million. American Homes for Rent is a buy to rent outfit, and it already owns 53,000 houses. Now is massively building new houses specifically to rent. And Brookfield Asset Management set up a fund to get into the real estate market. Blackstone Group, which started Invitation Homes during the mortgage crisis and sent out to its way to IPO, has since then cashed out, now invested $300 million in Tricon Residential Incorporated, which owns over 30,000 single-family and multifamily units in the U.S. and Canada. Invitation Homes, the largest buy-to-rent outfit with 80,000 single-family rental houses, is now buying houses at a rate of about $200 million every 3 months. These buy-to-rent companies have already also raised almost $6 billion by selling rent-backed structured securities. The buy-to-rent companies, such as Invitation Homes, have reported record-high occupancy rate and on-time rent collection. I will get to that in a moment and explain this, so let me highlight it over here so I don't forget it. But I do want to explain one key thing that if you haven't been paying attention so far in what I was reading, it means that these large companies are going out there and buying as many single family homes as humanly possible. Why? Because people need a place to live, right? And so housing is something that we are seeing that is being compressed. There isn't as many homes out there as the population is growing. Now, could that shift over the time? Absolutely, everything can shift over the time. But right now, based off of the homes and based off of the growth of the new population coming in, there's going to be this time while the boomers are still alive, no offense, boomers, and you have the millennials, which is the second largest generation right there with the boomers, with the Gen Z are starting to grow up or have already grown up, and they need homes. They don't want to live with mom and dad anymore. So now you have two giant populations still alive, which means that there's a compression in the housing component. Now, at some point, baby boomers will go away, right? And it's just the truth of life, right? And so at that point, we could experience more homes than people, potentially causing a dip in single family homes, maybe, but it's also going to depend on the communities, because let's also agree that what a 25 to a 30-year-old or even 40-year-old are looking for in a home is very different than what a 70 or an 80-year-old is looking at a home, right? Very, very different segments of population, locations, and that kind of stuff. When you're in your 30s, you want to be close to the happenings, to the life, to the things. When you're in your 80s and 90s, man, you want peace and quiet so you can sleep, right? So it's a very different spectrum of things that we're looking at. But one of the things that I have been very passionate about in talking is that, I see the future where less than 1% will own 99% or more of all of the housing out there. Everybody else is going to be basically renters. We nowadays, I remember way back when you can get one of these things, right? You could actually buy it. You would buy it and you would own the freaking phone. Nowadays, you can't really buy the phone. When you go out there to, Verizon, AT&T, whatever, it's leased. It's leased, right? We used to buy and collect books. Now we lease them through, Audible or, whatever. We used to buy movies, we lease them. Certain things make sense, certain things don't. And so, we would buy cars. A lot of us lease cars now. We used to buy homes, now we rent homes. So there's a shift in mentality of people really living in the constant sort of payment mechanism. And the smart money, what is doing is recognizing, wait a minute, wait a minute, wait a minute. If that's the direction where the future is going, where everybody's comfortable on an ongoing basis making the payments, right? The subscription model, as some people will call it, then why wouldn't I own the assets that collect this monthly payments? Because your expense is my income and my expense is your income, right? Especially if the money comes your way. So you got to think about it that way. That's the reason why we are doing it, and that's the reason why I'm so passionate right now, where I'm talking about, you got to go in, you got to learn how to properly invest in real estate, how to properly invest in some of these assets, where to look for it, how to evaluate it, because where I see the future is that more and more people are going to go onto the renter side, and fewer people are going to be the investors that are actually making money from this whole thing. That is why is key. And if you're interested and you're saying to yourself, this all makes sense, Nev, well, go and visit onedealaway.com. Go over to the on-demand or the products, see what we have, see what we offer, and I believe that you will find that the prices are ridiculously low for everything that we are teaching folks in how to do this. My number one favorite thing, I mean, I like all of that stuff, and it just depends on what you're looking to learn and what you need in life. But my number one thing when it comes to real estate is, and probably the most affordable one, definitely the most affordable one, is real estate on the cheap challenge. So just putting it out there again, your decision, you do you, I do me, we're all happy. Now, the other piece that I wanted to share with you is one of the things that they're saying, that the buy to rent companies such as Invitation Homes have reported record high occupancy rates and on time rent collection. Now, this is coming in from the fact that, is it true that they are just so smart that they're investing in all these things that we're hearing people can't pay and they're not as occupied and all of these things? Is it true that they're like super smart where they're like succeeding? Yes and no. It just depends on which areas and which markets. But also one thing to understand is, on the balance sheet, these companies can actually go out there and sort of put in that is on the account receivables they can basically change the gap. Accounting has changed where they can now basically claim it as still coming, even though it's not, because they have worked out some sort of deal with that particular tenant. So you got to be careful when you're looking at some of these publicly released reports and accounting stuff. It's not illegal. They have allowed that to happen when the CARES Act was passed. They have allowed to happen, and if you want to learn more about it, there's plenty of videos out there that you can go and watch and listen to. Invitation homes are getting into the sale leaseback market, buying single family homes from homeowners and leasing them back to the former homeowners. And the sale leaseback method of raising cash has been practiced for a long time by owners of commercial properties, airlines, equipment, and so on, but not in the single family houses. This is brand new thing that is now developing. 7% of the mortgages are in forbearance and others are delinquent. And we believe that this is going to be the huge thing that is going to get them right into the market yet again. So they're going to buy again on the cheap end of things, and they're going to rinse and repeat the process. With the sale leaseback, they could sell the homes and lease it back. So the owners, right? They can sell the home, lease it back, so they become renters and wouldn't have to move. And startups are getting into this deal, raising a lot of money to do this. Companies are lining up to take advantage of the whole mess of what is coming in. And my question is, why aren't you? Right? But you are, because you're watching this and you're learning and you're getting yourself ready to do the same thing. It will produce another wave of homes being taken over by investors and becoming an asset class. Huge amounts of money are playing in various ways in the market for single family homes, throwing many billions of dollars at it. And I think that's a very, very important piece to understand. Now, what is happening with the mortgage delinquency? Well, the rates are going up. According to the latest data from CoreLogic released on Tuesday, 6.6% of mortgages were in a stage of delinquency in July, a jump of 2.8 percentage points from the same time last year. Early stage delinquencies are still down 0.3%, and 60 to 90, 89 days are up 0.4%. And the biggest jump, 4.1%, is those that are severely delinquent, meaning more than 90 days. And you can actually see it right over here where it is, right? So this is the light blue is 2019, the dark blue is 2020. And you can see that the 30 plus days, the up to 30 days, the number is really, really high. Then we kind of drop down here, the 60 to 89 slightly up, 90 to 119 up, 90 plus is really, really up. So these are the things. And then, of course, not in foreclosure. There's a lot of places that are not in foreclosure. So there's a lot of things coming. The reason I share this with you is so that you can prepare. There's a lot of things coming our way that I think makes sense for you to be able to position yourself correctly and do what the big boys and girls are doing. Now, talking about a really, really big money and what the heck they're doing with the Big Short, here we go. ICANN is shorting commercial real estate market, which he says is going to blow up. So billion investor Carl Icahn expects the U.S. commercial real estate market will crumble. He's shorting the commercial mortgage bond market, and it's his biggest position by far. Short selling is a bet against the stocks or bonds with short borrowing shares from an investment bank and selling them in the hopes that the asset will lose value. Short buys the share back and return them to the bank, returning a profit and a difference. ICANN short is specific to credit default swaps, or CDs, which are assets that back mortgages of corporate offices and shopping malls. Sorry about the jumping. I promise I'm not doing anything. Hands are up here and you can see it. It's doing it. So it's the website itself. I don't get it. The banks went out and loaned money against a lot of shopping malls, office buildings, hotels, and retail, and it's credible institutions doing it all over again. The banks sold mortgages in commercial real estate, and then when they did those mortgages, then they would slice and dice them, put them in something called CMBX, an index, and then sold bonds against these mortgages to clients. So they're literally making money on both ends of the trade, right? Hoping that everything stands up. The problem is that the one moment either one of them falls, everything falls down. And so he's betting that everything is going to go down. I can expect shopping malls and others in commercial real estate will default on these loans. A lot of these bonds are now in grave danger, and this is short 2.0 or short 2020. Now, I do want to take a look at what is going on and what commercial mortgage backed securities are, because we are here to learn. So let's read it. Fixed income. So, what are commercial mortgage backed securities? CMBS. They're fixed income investment products that are backed by mortgage on commercial properties. There are no rules for standardizing the structures of CMBS, so their evaluations can be very, very difficult, and as such, they do pose a bit of a risk from that perspective, but also from the default of the commercial space, which we know, more likely than not, will be poised to default. As with collateralized debt obligations, CDOs, and collateralized mortgage obligations, CMOs, CMBS are in the form of bonds. They're mortgage loans that form a single commercial mortgage-backed security and that act as a collateral in the event of default, with principal and interest passed on to the investors. Now, they're contained within a trust, diversified in terms of property types and amounts, and loans for properties such as apartment buildings, complexes, factories, hotels, office buildings, office parks, shopping malls are often within the same trust. Now, this type of debt is non-recourse debt, which is debt that is secured only by collateral. So the difference is that when you buy, let's do this. When you buy a house right here, right? This is, of course, collateralized by the asset itself, right? By that house, but also your income, which is why the banker asks you for your credit rating, for your income, for all these different pieces of paper that you have to keep providing to them, amounts and mountains of paper that you have to keep providing. Now, when it comes to commercial real estate, when you borrow for commercial property, right? So let's draw a commercial property, right? So that's going to be a building. That's a very ugly building, but I think you get the whole point. The collateral component is basically the asset itself. The banker never asks me to provide my income and my job and my credit or any of that stuff. They don't care about that stuff. So I am pretty much irrelevant in this process. The only relevant thing here is this guy over here, and can that income provide enough to mortgage or to service the debt? That's the difference. And so these loans are non-recourse, meaning that if something happens and defaults and I am the owner, or the company that I own is the owner, they won't come and repossess my car and my house and 10,000 different things. That's basically what that means. Because CMBS are complex investment vehicles, they require a wide range of market participants, including investors, a primary servicer, master services, special services, direction certificate holder, trustee, rating. I mean, you can see this gets super, super complicated. It's like 20 levels deep. Now, what are types of CMBSs? Well, they're classified into tranches according to their levels of credit risk, and they are ranked from senior, or the highest quality, to the lowest quality. The highest quality tranches will receive both interest and principal, and the lowest basically gets the highest interest rates, but of course it takes more risk. And so if a company was to default, for example, and on one or more loans, then the highest tranches basically have to be paid off fully. They get paid, the interest and their principal. And then as they kind of go down the tranches, if you're in the lowest one, while you might have had the highest interest, there might not be any money left for you. So you're basically left high and dry. Now, it also talks about, well, they get paid the principal and interest, but that works only if only a small component of the stuff gets paid. Or the small component of the small number of the mortgages sort of go into the default. When we see a larger number of mortgages going into the default, right, nobody gets paid. Nobody gets paid because there is no money. Right? There is no money. Money is not coming in. Nobody's paying anybody anything. And that's where the big risk is. Now, typically only the wealthy investors invest in CMBS because there are not many options here for the average investor. Many real estate mutual funds invest a portion of their portfolios into CMBS. And this is the part that I wanted to share with you. Many of you might be in mutual funds, and you might be in a mutual funds through your retirement fund. What that means is that you're invested on the positive side, and that's the part that I was sharing yesterday with you. You don't even know it, but you own some of these malls and offices and retail spaces that potentially could be going down. And you don't even know it because it's packaged within these mutual funds with which hold all these different components. And so when things unravel, guess what? You take a hit. You take a hit because you're not hedged properly. Big investors hedge. That means they hedge on the plus side and on the downside. It just depends on how much on which end, so that they end up doing just fine and they get out of the hot mess. We end up holding the bag in so many different ways. And that is why you're here, to learn how to not be a bag holder at the end of the day when things go down. Now, what is the CMBX index, right? Because that's the part that we were talking about that Carl Icahn actually is shorting. CMBX indices are a group of financial indexes that track the commercial mortgage-backed securities, CMBS market. There are 25 tranches of CMBS, each with a different credit rating. Because mortgage-backed securities are illiquid and not standardized in over-the-counter market, they often lack the transparency and regulation of listed services, and these indexes help provide liquidity and transparency. Like, that's the goal of the whole thing. These enable investors to gauge the market and take long or short position via credit default swaps. And he is taking the short position on credit default swap, which puts specific interest rate spreads on each risk class. There are 5 separate CMBX indexes for ratings ranging from AAA to BBB minus based on a basket of 25 CDs, right? And of course, AAA is the best and BBB minus is the worst. Remember how we said senior and then you go down? Well, senior is AAA and then you go down to this BBB minus. They are reconstituted every 6 months to bring in new securities and thereby continuously reflect the current health of the CMBS market. Daily trading involves cash settlement between the two parties to any transaction. This pay-as-you-go settlement process considers 3 events in the underlying securities as credit events. So principal write-downs, principal shortfalls, which means failure to pay on an underlying mortgage, and interest shortfalls, where current cash flow pays less than the CMBX coupon. The introduction of indexes like CMBX has led to massive growth in the structured finance market, which includes credit default swaps, commercialized mortgage-backed securities, commercialized debt obligations, and other collateralized securities, which is all of these things are derivatives, right? All of them are derivatives in it, and that's the reason why the derivative, well, not just this, but this is an example of why the derivative market is the largest market that exists out there. This is where the largest amount of money is constantly being churned over. You and I play a very, very small game when we go and buy a house, right? To us, it's a good deal, right? To them, that's nothing. That's like, penny on the street for most of us. You're like, it's a penny. It's dirty. I'm not picking it up, right? But so you got to understand this stuff, right? The trading of the CMBX tranches is done over the counter, and liquidity is provided by a syndicate of large investment banks. Average investor cannot participate in the CMBX indexes directly. So you can't go out there and do what Carl Icahn is doing, right? Now, he is shorting CMBX 6. That is what he is shorting. I don't know if you knew that, but here, let me tell you what it is. And of course, you can see that shares of U.S. regional malls is 0.5%. Increase of credit investment since 2012, 4.8% are base projected losses for CMBX 6. Now, this one is arguing that it's potentially, CMBX 6, you shouldn't be shorting. You should go positive. I don't know if I agree with it, but again, I like to look at things from both ends of the spectrum because that makes me smarter. So I'm not going to argue with the whole thing. I'm going to learn from the whole thing. CMBX6, the acronym, has splashed across headlines and become the source of controversy on Wall Street. It's such a popular trade by speculators placing bets on store and malls closing that shorting the CMBX6, a commercial real estate mortgage index, has been profiled in the media as the next big short. Short sellers' assertion is that the American mall is dying and that the near term defaults and losses on CMBX 6 loan pool will therefore be high, meaning they will default and those that are shorting it are going to make it big. Okay, like really, really big. As many as one third of 1,100 regional malls in the U.S. are at risk. Mall owners often support their assets, especially if a mall is regionally dominant. Such a mall has a potential to consolidate tenants, right? Some of the 37 regional malls represented in the CMBX 6 can't survive, but most are dominant within their trade areas and produce ample or sufficient internal cash flow to support both capex and debt service. Capex is capital improvements, in case you don't know what that means. Even if the American mall were dying, short selling the CMBX 6, which holds less than half of 1% of malls in the US, to express that view is inefficient. Not only would overall loan losses likely be modest, but also returns on CMBX 6 will ultimately be attractive. Here is basically why they're saying, you probably, the short sellers are missing critical points. Most of the CMBX 6 is backed by non-retail assets that have enjoyed material growth and not operating income. These assets are not expected to suffer meaningful losses. Most of the 37 underlying malls produce significant internal cash flow, makes them default less likely. Regional malls in the CMBX 6 are likely to fully or at least partially pay off their loans at maturity. Mall loans losses may not occur as quickly as short sellers anticipate. Special servicers are likely to work with borrowers to minimize losses by extending loan maturities and making loan modifications. Loan losses on the entire CMBX 6 collateral pool will likely be modest, and returns on the CMBX 6 are likely to be much higher in the long run. Speculators are betting against CMBX 6 in part because it's heavy exposure to retail, and they're saying just 29% of the average CMBS deal issued since 2010 has been retail loans. So they're saying vast majority is not even retail in this whole thing. Given the CMBX 6 7 years of seasoning, the pool has both remarkably low default rate and rate of loans that have been liquidated with a loss. High loan payoff and low delinquency rate, inconsistent with commercial real estate 10-year recovery since the global financial crisis. Now, a couple of things that I do want to point out. I don't 100% agree with it, right? Like I said, I'm not going to argue it completely. I think it's important to see it. One of the things that you have to understand is that this company sells the product. So, of course, they're going to talk it up, right? So that's one thing that you need to keep in mind. Are they educators or are they sellers? There's a huge difference in it. Because if you ask a good salesperson whether you need 3 pairs of shoes, he or she will sell you 5, right? That's their job. Their job is to sell. Their job is to sell. They make money on sales and on commission. Educator will probably ask you much more pointed questions and force you to start thinking for yourself and make your own decisions. So that's one thing that I want to point out. The second thing that I want to point out, they're looking at the history. They're saying, hey, last 10 years, this was doing great. And last 7 years, this was doing great. Well, that was in the past. The past performance doesn't equal future, right? So that's something to understand as well. And some of the things that they are talking about here is that while it's true that many of these, non-retail assets have enjoyed, growth and all of that stuff, you also have to keep in mind that things have gone down, right, in prices, in valuations. Economy has slowed down. People are not eating out. They're not traveling. They're not staying in hotels. We all know that stuff. And what does that mean for commercial real estate? It means that their income is going down. When their income goes down, the valuation of the property goes down. Exactly. Now, we've learned all of this stuff, and now you're going like, wait a minute, Nev. You told me of all the things that are happening, that how, commercial real estate is poised for Big Short 2.0 or 2020 or 2021, however you want to call it. You told me how all of this big money is playing in the CMBX. You told me what it is, and then you told me I can't play in it. And when I do play in it, I'm on the positive end, not on a negative end, and I can't even get out because it's part of my retirement. Now what? Thanks. Thanks for depressing me. Happy Friday to you as well. Well, this wouldn't be a full show if we didn't go in and take a look at some of the things that might, I'm not saying do, I'm saying might make sense for you. Not a financial advice, not licensed to give you financial advice. I'm just sharing my thinking of what I think might make sense of how to sort of play within the market in a way that we can, right? In a way that non institutional investors, non large investors, simple mortals like you and I can participate in. One of those ways for me is that, okay, if all of these big boys are jumping into single families, right? Maybe I should do the same thing, right? So I go out there and put that on my, maybe that's one thing that I can protect myself with, right? And maybe I should stay educated, informed where the good places are to buy. And maybe I should take some courses to intellectually stimulate my brain and learn ways where I can go and buy these things at much, much cheaper in order to sort of, get myself prepared for what is coming, which is the giant transition of wealth that I believe, and giant transition of where people are living, right? All of those things we're seeing play out as we speak. Then I go out there and say, well, industrials and stuff. So if I have substantial amount of money and can go in that, then I might say, well, maybe going into industrials might not be the worst idea on the planet. So I could potentially do that, whether through syndication or individually. Maybe I'll partner up with folks. So that's another way that I'm going like, check, that's one of the things that might make sense. The other one that is a much more liquid way, I'm not crazy about this way, but I'm going to talk about this way because, and I'm not recommending it. Please understand that. So don't be going out there buying this stuff and doing this stuff and saying, well, Nev said to do it. No, 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 no. Nev didn't say anything. Nev is just sharing stuff to give you ideas so that you can go out there, research and learn, continue to learn, and then understand what to do. So now I'm thinking, well, if commercials are going to go down and I can't go into CMBX, right? And I can't play the way that the Carl Icahn can or the large institutional banks because I don't have $600 billion to put into one market, right? So, but I can, I can do things for myself at my own level. We all have a game to play, and the game is acquire as much cash as you possibly can and then keep it. We are very good at acquiring, not so good all the time at keeping. And the goal is to do both, acquire and keep. And this is the message that I want to meditate on today. Keep. That is my word of the day today. 3 inverse. Whoa, this thing is like rolling like crazy. All right, let's try this. 3 inverse REITs ETFs for betting against real estate. Now, you know what the REIT is. It's Real Estate Investment Trust, which is investment vehicle that owns or invests a variety of income-producing real estate, such as apartment buildings, industrial buildings, hotels, offices, shopping centers, malls. So they're very, very diversified in student housing. And I think we've talked about the problems with student housing for some of these places. And I think we also have a video on that as well. So if you want to learn about that, I got the video for that too. And then, of course, ETFs is an exchange-traded fund, which gives investor access to real estate markets without actually going into it. Now, you can go positive or you can go negative. And many people, when they play in REITs, they're playing on the positive side of things. However, they're inverse ETFs, and inverse basically means you make money when things go down. So it's kind of like shorting, right? Except you're not doing true shorting per se, because true shorting means that you go out there, you borrow the stuff from the broker, then you go out there and you sell it, right? And then, right? So we're not going to do that piece. This makes it a bit easier for a regular mortal to participate in the shorting of the real estate that, is probably just as risky as everything else. Everything is risk, everything has risk. So you got to study this, you got to educate yourself. If you need financial advice, make sure you find yourself a financial advisor that is licensed to do this stuff. And above all, educate yourself on this stuff. So like I said, do not invest in this stuff just because I said so. All right, cool. I feel like I've done my due diligence to talk about. So there are three different inverse REITs, ETFs that you can potentially look to get into. ProShare Short Real Estate, which the code name is REK, seeks to return negative 1x the daily return. So the daily return Dow Jones U.S. Real Estate Index before fees and expenses. So it's one for one. It's basically not weighted at all. And this particular fund is heavy weighted in equity REITs with about 92% of its holding in this asset class. Okay, so you want to actually look at their prospectus to understand what exactly are they buying and selling and holding, to understand of what it has. Okay, and you should be doing that every time when you decide to invest in any ETF, in any mutual fund, in anything. Okay, so and we'll take a look at the charts before we end for the day. Then the second one we have is the ProShare Ultra Short Real Estate, SRS. Now this gives you 2x return, or the negative 2x as they call it, right? So it's the inverse. So if the market goes down, you go up twice as much. So if the market goes down 5%, you go up 10%. Inversely, if the market goes up 10%, you go down negative 20. So it's much heavier risk because you are leveraged. Whenever you have leverage, you take on more risk. But of course, it also gives more reward. So you gotta pay attention to how much risk are you willing to accept. Don't just look on the upside, which is always fun and motivating, but you gotta consider the downside as well. And I will teach you one thing for free. I think I taught you a lot of things, which, you know what, by the way, talking about teaching you stuff, smash that like button if you feel like you've gotten anything out of this entire episode. And feel free to put in comments. Sorry. One thing that probably one of the best mentors that I've had many of them, all of them were great. From some mentors you'll learn what to do, and from some mentors you'll learn what not to do. So every single mentor I have ever had, every single teacher I have ever had has been the greatest blessing in my life, even the scammy ones. That's right. But he taught me one thing. He said, Nev, focus on protecting the downside, and the upside takes care of itself. So that's one thing I'm going to pass on to you. Not my thing. I mean, it is my thing now. I live it, but it's, I didn't come up with it. I learned that from him. All right, so you want to, SRS is number 2, and number 3 is Direction Daily Real Estate Bear 3X ETF, DRV. And this one is triple. So if the market declines by 5%, you make 15% return. If it goes up 10%, you lose 30%. So you also want to pay attention to this one. So this one is even higher potential risk. Now, here is what I wanted to show you a little bit is the chart. This is, okay, let's see. This is the REK. So the REK, you will actually see that this is the ProShare Trust Short Real Estate ETF. So this is where the prices are. And as you can see, it's very much consolidating. And you know what? We can probably go in and play around with these charts tomorrow, and we'll continue to do that. But I just want to show this to you today. So let's take a look at SRS. As you can see, very, very similar story of happening. It has kind of come down, and now it's sort of percolating sideways, right? And the third one is the DRV, which is doing the exact same thing. It's come down and it's going sideways. And as I have said over here, tomorrow we are going to play around with some of these charts and take a look into them a little bit deeper. And of course, we're going to be probably discussing a bit more about crypto and that kind of stuff. So if you are interested in geeking out a little bit on the trade side of things, analyzing charts, looking at stuff, kind of thinking through the things with me and learning a bit more about crypto and that kind of stuff. So that's what tomorrow's day is going to be. Yeah, I invite you to join me tomorrow for the next episode of Money Matters. And of course, we're going to go live at 7 a.m. I know it's Saturday, but I get up early every single day because it is important to be early, because they say early bird gets the worm. And hey, here this goes to the Big Short right over here, because he was early into the market, and that's why he made it big. So my attributes, contributes, whatever, to the Big Short guy who pulled it off really well and called it amazingly well. Again, if you need motivation, go and watch it. And hey, you can also watch the Wall Street 1 and 2. I highly recommend it, because as you get more financially nuanced and understand stuff, these movies end up being way more entertaining than without the knowledge. So as you're acquiring this knowledge and learning, go and watch these movies, because you will pick up way more stuff. So hey, thanks for watching. Smash the like button right now, subscribe, and I will see you tomorrow, only if you put in notifications. And of course, you can join me live on onedealaway.com. Until then, stay forever money blessed, and do remember, you are only one deal away.